Okay, very good morning. Welcome to the briefing for Monday, 9th of January. I hope you had a good weekend. I think I need to start by giving the good people of the London Underground a shout out. Thank you very much for giving me a great start to my week. You could have made it rain a little harder though. You've got to test me a little harder than that. 5,712 steps this morning clocked in, so I'm going to be optimistic. That's a good start to the day. So, moving on, a quick look at payrolls first, just to, looking at the charts, that's obviously still one of the major moves that we can see, that being this is what we were pointing at before the release came out, this kind of two-part reaction that's very typical of that piece of data. And what's, as I've said to you guys before, makes trading these kind of multi-faceted releases very difficult, and something of which requires really timing is key, and not being drawn into some of the initial price action is normally going to serve you best in terms of trading those events successfully. But just recapping, you had first of all the reaction to the headline reading. That's normally the knee-jerk reaction that you see in the market, and obviously that was a little bit weaker than expected, actually fairly similar to the kind of underperformance that was seen statistically in what we had in the ADP reading against consensus estimate. Initial reactions in the chart then, again it was 156 below the expected 178. We had that kind of initial pop high in the euro, which was kind of dollar weakness. Initial move lower in equities, but obviously as the other information started to come out, you had that very solid upward revision on the previous 178 to 204. You had a 2-month net revision, positive, plus 19,000, and then probably more important, because it's been the real key focus from the Fed, has been the performance of the average hourly earnings numbers, in both month-on-month and year-on-year. They were higher than expected by 0.1 each respectively. So on the balance of things, market may have well been a little bit more positioned as well, given the softness in ADP, for a weaker headline. That did materialize, but there was other more positive factors that outweighed that. And so going back to the overall reaction that we had after initial spike high in euro dollar, was a pretty decent and consistent trend lower. Equities reversed course and saw a pretty decent move actually all the way through into European cash flows and beyond, before then settling into a fairly quiet afternoon in the US into the close on Wall Street. That's quite typical after the non-farms release. And then yields saw probably the most sustained impact, so seen as a solid report overall. T-notes, although spiked up to that respective R1 at the time, on a very quick test it came all the way back down and then pretty much gravitated into the close toward that respective S1 level. So where does that leave us this morning? Well, just looking at the equity charts here in the middle of my screen, you can see that let's just add the display on here. You can see underperformance in the European indices at the moment. The DAX down, but the S&P still seen broadly flat to minor positive. So we've held on to a bulk of those gains that we're seeing post payrolls in the S&P. However, the DAX, since the cash open, so in the futures we closed the gap, and then the cash equity open we've kind of shot lower, as is quite typical on the pickup in volatility through that 8 o'clock marker. One thing that we have had is German industrial production this morning. Let me just show you that chart. It was positive 0.4%, which you might think is a good thing. However, the market was looking for a 0.8% reading this morning. So it was half the consensus estimate in terms of German industrial production, albeit the second straight month of growth. So that was a little bit weaker. It may have acted as a bit of a catalyst. That data came out at 7, and at 7 we did see around the open in futures we kind of gradually drifted lower and closed that gap. Elsewhere, other charts that are really kind of sticking out to me this morning is cable. You can see euro dollar. If we're looking at both major pairs here, the dollar index is broadly flat to minor positive, but euro dollar's up positive territory, just shy of pivot, residing at 105.91 today. However, cable's down a point. You probably would have seen or heard their headlines. Theresa May speaking at the weekend, and the summary of it as a headline across most major publications is this: May signalling the UK to quit the single market in order to curb immigration. It's kind of the way that the most of the headlines were spun. She's still sticking to that fairly hard line about threatening to leave the single market, which would obviously be the kind of the biggest to the detriment of our economy, you would imagine, in terms of initial response and how people will look at that as a hard Brexit. And as such, pretty much from the off, we gapped down at the reopening of electronic trade. In Asia, we drifted lower as soon as Europe came in. The early birds kind of this morning, coming in towards 6 o'clock, we saw another run lower technically as well. Just taking out a couple of levels is probably just helping that downward move. You can see that support generally around the 28th and 9th, and then also just sub there on the 3rd of January, and then that's probably added to some of this downside price action. We trade sub 10 or 122 at the moment. So definitely a kind of bearish open for the pound currency, and it's all kind of coming out of this first televised interview of the new year from Theresa May, who said on Sky News on Sunday that leaving the European Union would be about getting the right relationship, not about keeping bits of membership. We are leaving, we are coming out. We are not going to be part of the EU any longer. So the question is, what is the right relationship for the UK? I don't know if you also saw it as well at the weekend. Theresa May was quite direct in terms of, obviously Trump at the end of last week was saying, or he was tweeting, how excited and looking forward he is to meeting Theresa May about the special relationship between the US and the UK. But Theresa May was pretty strong at the weekend in that Sky News interview, talking about his derogatory comments to women are unacceptable. So it's definitely going to be a very interesting meeting when that takes place. Moving over to some other charts to have a look at this morning. Let me just flick this over to Crude, which hasn't seen a particularly large move by any means, but we are negative around 25 cents, 53.74. We've had pivot, a very early test of that this morning, and more recently. It's kind of where the price action has been gravitating at the moment. But a couple of headlines I sent out to you this morning. Around Iran, actually, their exports are surging, and we'll have a look in a second. US oil rigs are also surging. So two potential downward catalysts for this price action to be aware of. Increased exports from Iran, obviously undermining efforts by other oil producers to curb a global fuel supply overhang. US drillers increasing activity for the 10th consecutive week. Starting with Iran, obviously last week you had generally let's have a look at a bit of a longer dated. You had that big move lower without any real news that occurred on the 3rd. That was last week. However, we had a pretty decent recovery of most of that loss. Now, most of the headlines have been, somewhat surprisingly, that the likes of Saudi and so on, all the major players have been adhering to their quotas. If not, some countries are going to be even going beyond that. So any nervousness there may have been that actually the implementation of these agreed deals would fall through, that has not proved true at the moment, and that certainly has been a supportive factor. However, Iran has sold more than 13 million barrels of oil held at tankers at sea, capitalizing on OPEC's output deal, from which it is exempted, if you remember rightly, to regain market share and court new buyers. So they're doing the absolute opposite at the moment, and actually they're benefiting from this situation. The other thing, though, was rig counts. I've got two real charts here for you to have a quick look at. And this is mapped WTI crude and the US oil rig count. And you can see here that US oil rig count's now risen for 30 of the last 32 weeks. And we're now at the highest in 1 year in terms of US rig counts. Now, this is certainly something, if prices going off the broader consensus are to continue to edge higher, and we get to 55, 60, and then even up to $70, certainly this US oil rig count situation will be something to contemplate when we get to those more elevated levels by more recent historical price points. But you can see here that the rig count does, as probably to be expected, lag the actual performance of crude, but crude continues to move up, so you would imagine that trend should continue, at least for the time being. Looking at following lagged oil prices and leading US crude production higher, you've got here US oil rig count is the green, and crude production. So then this is obviously the next thing you want to be looking at, is how responsive can the US output be, and how quickly can they turn the taps back on, because ultimately that's going to be to the detriment of this agreement between OPEC and non-OPEC nations. If they can ramp this up fairly rapidly, which of course the shale industry has proved to be highly flexible, or more so than probably the Middle Eastern names would have thought a few years ago. So certainly that's something which I am just keeping a half an eye on as well as we go through the coming weeks. Bit of a longer term play, I guess, but certainly from a crude perspective to be aware of. Quick look at some other things from a news point of view that I want you to be aware of from just your general knowledge is, after you have a non-farm payrolls release, this is a fairly, I would say, routine practice by the Federal Reserve. And as you can see over the weekend, we've had, 7 Fed speakers at the weekend. What the Fed normally do is, after non-farm payrolls or after a big interest rate decision, they will pre-schedule already across Bloomberg, the Journal, the FT, speakers. Now this is kind of a fail-safe in case the market misinterprets what it is that the Fed have communicated, or the market overprices, let's say, something like a non-farm payrolls release. Now, I don't really think that that's happened on the last Friday's data itself, but nonetheless, always got to be listening when Fed speakers have been on the docket, and really you're ignoring much of the non-voters. It's the four at the top that are really more important. So 2 neutral, or 3 neutral, 1 dove. Powell states it does not see broadly unsustainable asset prices. Low interest rates have led to support for progress on inflation and employment. So very much just backing the Fed's decision of where we currently stand. Kaplan states that they can raise rates in a gradual and patient way. So reiteration of that language that exists, of course, at the moment, that kind of cautious approach. Harker, the other neutral, states that it's penciled in for 3 hikes. Obviously, that is what the summary of economic projections predicts, so very much on point. And Fed's Evans states that the current global economic climate is weak and uncertain, while 2 hikes in 2017 is not unreasonable. Three hikes, though, is not implausible. So you can see there the kind of dovish nature of Evans, slightly more leaning that way, looking at 2 rather than 3 possibly. So nothing really too much there that deviates from the norm. I'd say most of these guys are probably more on point rather than being an outlier in terms of uber hawk or uber dove. Looking at the calendar then for today, it is fairly quiet. Looking further forward into the morning, really there's not a great deal going on, but I certainly would be keeping an eye on this kind of pound situation. I would say we're kind of more prepped, I guess, for a weaker sentiment for the sterling currency specifically, just on the back of those comments out of Theresa May. Next kind of line on the charts, obviously we're looking at the S1 level to the downside. That comes in at 121.71. Otherwise, into the afternoon, again, pretty quiet. Nothing really major coming out of the US, but you do have a couple of Fed speakers, Rosengren and Lockhart. That probably then takes me on to the week, because what you guys should do on a Monday is very much you want to be strategizing over when is it in the week that, from a schedule point of view, you're probably going to get presented with your best trading opportunity, because that way you can kind of allow or almost allocate where you're going to put your firepower, if you like, in terms of, is it on Tuesday or is it on Thursday when the main things are happening. Now, one of the things I want to point out is that for me, one of the biggest events is coming up this week, and that's not actually economic data. That is on Wednesday, President-elect Donald Trump gives his first press conference. Now, this is the first press conference. He's talking on general topics as a whole, It's a full press conference. It'll be the first one he's actually given since the day of the election. He's not actually given a speech. All he's done, these hundreds of comments that you've seen, have been tweets or the odd comment to the press. They've not been a full, thorough insight into actually what is it on his policies, and more broadly speaking, what is it he's thinking. And this is going to present that opportunity. I think is probably going to be one of the bigger events of the week, for sure. Because at the moment, in terms of all of the macro themes that are going on, this is certainly one of the biggest drivers of financial markets. So watch out for that on Wednesday. You want to have your plenty of ammunition, I'd say, for that event. Now, other things that you've got this week. Tuesday is fairly quiet, but when we come back in tomorrow morning at this time, you've got Chinese CPI, PPI retail sales, so that might influence the open of Tuesday. Fairly quiet though from a US perspective for data on the afternoon. Wednesday, UK manufacturing, IP, trade balance, construction output, so definitely a couple things to look out for there with the regular oil inventories, but Trump will be the main headline act. Thursday, again, pretty quiet, regular weekly jobless. ECB minutes is always really a non-event, that being mainly because Draghi gives a press conference after every meeting, so very much well communicated, so the minutes are fairly dated. And then Friday, you get a bit of a pickup in the US. You've got retail sales, PPI, Michigan sentiment, business inventories, and then actually something to keep an eye on for crude traders going forward is the rig count. Just flicking back to the charts, just to wrap things up, having a look at the DAX this morning, just keep an eye there. Obviously getting pretty close to, well, that was the low that we printed on Friday morning. We've just tested here, and then we've got the low from the 4th and the 5th just below here at 11,528.5. So DAX under a little bit of pressure this morning. As I say, a bit weak on the German data from the off. But otherwise, I'd say fairly quiet, not really a great deal of major headline news flow. Okay guys, going to leave it at that, coming up to 9 o'clock, so enjoy your trading day, and I'll see you in the chat room. Thank you.